And welcome to today's webinar session, and thanks very much for joining us. My name is Monique Charland, and I'm the CEO of the national franchisor company called Business Accounting Network, or better known as BAN. And as the first and leading professional accounting, business advisory and tax franchise in South Africa, and also in our capacity as accountants and being business owners ourselves, we have identified key areas where smaller businesses and their owners miss out on a guaranteed way to mitigate compliance risk, improve and create wealth worth having, and use the strategic advantage and competitive edge that big business does naturally. And so we would like to do some investing of our own by showing you, by way of our monthly complimentary webinars, the common mistakes we see business owners make and how you can avoid them. So today we are asking the question, is being a member of a closed corporation as easy as it's cut out to be in terms of the Closed Corporations Act? And we will be covering duties and responsibilities of or of members of closed corporations, personal liabilities that they could be subjected to and risks, and also criminal sanctions. So our host for today's webinar is the Proficient Webinar Guru. That's Shane Webb, who's based in Howick in KZN. And I'd like to kick off by introducing our presenter today, Madeleine Pretorius. Now, Madeleine is a BAN franchise owner. She's based in Paarl in the Western Cape, and together with myself, heads up the technical training within the BAN franchise group. Madeleine is a qualified chartered accountant. She qualified in 2012 after completing her cycle articles at PricewaterhouseCoopers in Gauteng, and she's a registered CA with the South African Institute of Chartered Accountants. So just a little housekeeping before we get started. We would love to hear from you. So if you have any questions during the presentation, please type them into the question box in your control panel. It's on the right-hand side of your screen. You may address questions for the panel, who will consist of myself and Madeleine, at any time during the presentation, which we will then address at the end of this webinar. Now, our last month's recorded webinar was on directors' risks and liabilities, and that can be found on BAN's website. And that's also available for downloading. If you would like to obtain today's copy of the webinar, could you please email our head office at admin@ban.co.za, and we shall email you the recording. So this is Monique Charland saying goodbye until I hear your questions later while on the panel. And so now, without any further ado, I'm going to cross over to our presenter today, Madeleine Pretorius.
Everyone, and welcome to our webinar today. We are having a look at the Closed Corporations Act, and specifically those sections relating to members, their duties and responsibilities, potential liabilities, as well as criminal offences. Let's start off with some background. The Closed Corporations Act was enacted by Parliament in June 1984. And it regulates closed corporations. So the formation, registration, incorporation, management, control, and liquidation of closed corporations. Now, the intentional purpose of the Act was to enable smaller businesses to acquire corporate status with a legal personality distinct from its members. In other words, a separate legal entity that you can run your business from, which protects the members from liability of that business, and it also allows for perpetual succession. So if something happens to the member, that business can still carry on. So because the administrative complexities associated with a company are then avoided, a closed corporation is much simpler, less complex, and less expensive to operate. What's interesting as well is that the Act was intended to be largely self-regulating, meaning that the members are required to take account for their own actions and use their own judgment when applying the regulations of the Act. And so there are instances that if they contravene certain provisions of the Act, they will lose their limited liability and they will become liable for some of the closed corporations' debts. With the New Companies Act of 2008, there are certain provisions that create changes that affect the Closed Corporations Act. The first of these is that the requirements of the Companies Act to calculate a public interest score each year to determine whether the company is required to be audited or not is now applicable to closed corporations too. So it is now the responsibility of management, or if it is an owner-managed business or a closed corporation, it would be the member, to calculate your public interest score annually to make sure that your closed corporation, if it shouldn't be audited, it is not audited, and if it is supposed to be audited, that it does get audited. Now, because of the nature of closed corporations and because it is smaller business, the likelihood that a closed corporation needs to be audited is very small, but there are some that do require audit. So per regulation, you do please need to calculate your public interest score every year. Now, what is the public interest score or the PI score? It is an allocation of points or calculation based on a number of factors, like, for example, the number of your employees, the amount of your turnover or external liabilities. And that calculational score will then determine whether you are required to be audited as a closed corporation or a business or not. Now, under the New Companies Act, closed corporations may be subject to an audit, but they are not usually subject to an independent review unless this is voluntarily elected. Now, what is an independent review, you might ask? This is similar to an audit, but it is much less detailed and less intense, and it looks at a much higher level of testing and procedures than an audit would. It is usually also performed off-site, and it only provides limited assurance. In other words, whoever does or performs the independent review will then give an opinion based only on the work that was performed or the limited amount of procedures they tested, and not the overall body of records that are applicable. The independent reviewer would also issue a report, and that is then included in your financial statements. And as we will be talking about later when we talk about accounting offices and things like that for the closed corporation, that independent review report is quite important. Because if it is an adverse report or a qualified report, it could affect things like your ability to obtain finance and going to the bank and working with external parties. One of the other requirements of the New Companies Act that affects closed corporations is that if you are a closed corporation that needs to be audited, you would also need to apply the financial reporting framework set out in the company's regulations. Now, this financial reporting framework that the Companies Act refers to is usually your international financial reporting standards, which the professional accountants use. Now, this framework is much more complex than your, I would like to say in inverted commas, almost your normal accounting procedures, because it's a more complex way of valuing your assets and accounting for transactions. And there are many more accounting entries that need to be put through to bring your records or your books in line with these accounting standards. And you would most probably need a professional accountant to help you to actually comply with these standards. So usually if you are a closed corporation that does not require an audit, and you are not going to use your financial statements for external purposes, like sending them to the bank or something like that, then it would mostly be sufficient for you to use the tax base or accrual basis of accounting, where you would account for your transactions as they occur, as you would for tax purposes. The New Companies Act also provides that no new closed corporations may be formed after the 1st of May 2011. If you have an existing closed corporation, that will carry on indefinitely, but you cannot form any new ones. And companies can no longer convert to closed corporations, whereas closed corporations, if you would like, can convert to a company. The closed corporation provides, when we look at the duties of members, for the fiduciary position of members. So each member stands in a fiduciary relationship or a relationship of trust to the closed corporation. And per the Closed Corporation Act, this specifically means that members are required to act honestly and in good faith, to exercise those powers that they have authority for in the best interest of the closed corporation, for them not to exceed their powers or to act without any authority, to avoid material conflicts of interest between their own and those of the closed corporation, or to actually disclose those conflicts of interest if there are any. And they may also not compete with a closed corporation or obtain any personal economic benefit that is in conflict with the interests of the closed corporation. So in other words, keeping your business and the business of the closed corporation separate. Any member who does anything to breach this fiduciary position or this fiduciary relationship will be liable to the closed corporation for any losses suffered as a result of that breach. But interesting to note is that the closed corporation provides that any act by a member that might be a breach of fiduciary duty will not be considered a breach if all the members are aware of this act and they've actually given written consent to it. Naturally, if it's not an act which is contrary to the best interests of the closed corporation, but if it's anything else that would normally be a breach of fiduciary duty, but all the members have actually agreed to it, then that member will not be held liable. For example, let's say a member acts on behalf of the closed corporation and enters into a contract, and as part of the terms of this contract, the member is allowed to take a portion of the profits that will actually be going to the closed corporation. So he takes a percentage of those profits, almost like a referral fee or something like that. Now, you could think that that might be a breach of fiduciary duty because all the profits in that transaction should really be going to the closed corporation. And if the member is taking a percentage of it, shouldn't that be a financial conflict of interest? However, if all the members in that closed corporation are aware of this transaction, they have knowledge of the terms of that transaction, so they know exactly what is going to that member in terms of a financial benefit, and they've given written consent that they're happy with that, then there is no breach of fiduciary duty. There are also very specific responsibilities that the Closed Corporations Act provides for members. Members will be held accountable if accounting records are not kept in a manner required by the Act, and if they do breach this, they shall be guilty of a criminal offence. Now, accounting records doesn't only include your physical records and your transactions and things like that. It also includes your choice of accounting policies. For example, how do you account for your property, plant and equipment? What are your depreciation rates? And you might need your accountant to guide you in terms of choosing those, but the members are ultimately responsible for making that judgment in selecting their accounting policies. So what does the Closed Corporations Act include in terms of accounting records? What do they require? You need records of assets and liabilities, members' contributions, undrawn profits, revaluations of fixed assets. In other words, bringing your fixed assets to today's value from its purchase price value. So bringing your books almost to a current value. This will, in most cases, only be if it's a significant amount. In other words, if you are a property investment company, it would make more sense to bring your assets to a revalued amount than a cost price. And this is usually to give the financial statement readers a better understanding of your books. And you would mostly need your accountant to help you with that as well. Any amounts of loans to and from members also need to be recorded. A detailed fixed asset register. This includes your cost prices, your acquisition and disposal dates, any consideration that you receive for disposals, your depreciation method, so that would go back to your accounting policies again, your calculation of the depreciation amount, and you would most probably need your accountant to assist you to set up this detailed fixed asset register. Detailed cash records. And when the Closed Corporations Act refers to cash records, it's not only your bank accounts, it's physical cash on hand as well. So records of the nature of transactions, so any receipts that you receive, any payments that you make from your bank account or in cash, the nature of the transactions, you need to keep records of those. And you need to have a document or a receipt or some sort of paper, I want to say paper, but it could be electronic as well, some sort of support for all receipts that you receive and all payments or cash payments that you make. So it's very, I'd like to stress this detailed that the Closed Corporations Act refers to. Any goods purchased or sold on credit or services received and rendered on credit also needs to be recorded. So the nature of the transactions, who the parties are in that transaction, amounts, things like that. Inventory records, so that would be your type of inventory, their value, their cost prices, or whatever method you use to value your inventory. And the members are also responsible to take an annual stock count. And the information from that annual stock count or the results are then to be sent to your accounting officer. The Closed Corporations Act also requires for all supporting documents that back entries in the accounting records. So these would be invoices, slips, any sort of support, and it must be kept in such a way that you can retrieve it easily and match it quite easily and exactly to the transactions in your records. So to have a system in place is just so much easier for you to be able to keep these records as required. The Act also requires that precautions are supposed to be in place to avoid falsification, and some controls must also be in place to discover falsification of records if this is the case. Now, if you are an owner-managed business and you are the sole member, then these precautions might not be that important because you are accountable for the accounting records and for the business. You do the accounting records. You know that if there is an error, you are accountable for it. However, the moment employees come into play and there's a delegation of functions, then you need controls in place to make sure that if there are any errors or falsifications or anything wrong in your records, that you do pick it up. And you might actually here also rely on your accountant to help you to put these controls in place. The Closed Corporations Act does provide for a defense of a member, specifically for this requirement of keeping accounting records. So what does the Act say? The Act says that if the members have assigned their responsibility for this specific section in the Act of keeping the accounting records, and they've assigned that responsibility to a professional, a qualified professional, so someone who is competent and reliable, who they have reasonable grounds to believe can discharge this duty and has in fact discharged this duty, and then it later comes to light that they haven't, the members can use this as a defense. So if they have actually delegated this to a professional accountant, and it is the accountant's responsibility to keep the accounting records in the correct manner and to make sure everything is correct and true and complete, and the members have grounds, reasonable grounds to believe that this accountant has actually performed his job, and it comes to light then that something has happened, then the members can use this as a defense. Members must also, within a maximum period of 6 months after financial year end, cause annual financial statements to be made out. Now, before it used to be 9 months, but with the introduction of the new Companies Act, this has now changed to 6 months after the end of the financial year. These financial statements are required to be produced on a timely basis to help members with decision making and to be able to have financial information at a decent kind of amount of time so that you can use it in your business. It's also important to have this financial information timeously for solvency and liquidity requirements. Now, the Companies Act refers to solvency and liquidity requirements when certain payments are made. So a solvency and liquidity test needs to be done at certain points of time. And we will look at when those payments are made in a few of the slides later on. But solvency and liquidity refers to your assets exceeding your liabilities. So that's solvency. If your liquid assets, so that excludes inventory, exceed your liabilities, you are solvent. And liquidity speaks directly to cash flow. So if your business is able to pay its debts as they become due during the ordinary course of business, then you are seen to be liquid. And when we talk about debts that are due in the course of business, it's your creditors, SARS payments, salaries, any rentals, as well as long-term loans and the interests to be serviced on top of that. The financial statements are also required to be in conformity with financial reporting standards that are appropriate to the business of the closed corporation. They must fairly present the state of affairs at year end, so your financial position, as well as the results of operations or your trading results for that year. Now, the financial reporting standards that the Closed Corporation Act requires is really dependent on your business and whether you require an audit or not. So if you're required to be audited, as we mentioned before, then you will have to conform with the new Companies Act and use your international professional accounting standards. But if you don't require to be audited, you can look at what you are going to use your financials for and who will be looking at these financials and what type of business you have to decide which financial reporting standard will be most appropriate. So for example, if you are a smaller business, you don't need an audit, but you are going to use your financial statements and send them to the bank to obtain financing, then it might be a good idea, or it might be recommended for you to use the international financial reporting standards, but those for SMEs, so those for smaller businesses that are less complex, because it enables the bank to be able to compare your financial statements with those of other companies to see what your credit rating would be. If, however, you are a one-man show, you're a small business, you don't expect or anticipate for you to use your financial statements or send them to any external parties, then you can quite happily use the tax basis or accrual basis of accounting to set up your financial statements. What's interesting as well is when we look at the solvency and liquidity from the financial statement point of view, it really only refers to it from a year-end point of view, because we're only looking at financial statements annually. But if you have to do solvency and liquidity tests throughout the year as required by the Companies Act, you still need your accounting records up to date and complete on a regular basis. So we always recommend that you get monthly management accounts to make your life much easier and be able to do this when it is called for. The financial statements must also be signed and approved by the majority of members, so those owning at least 51% of the members' interest. Every closed corporation should calculate its public interest score at the end of each year, as we've mentioned. And if there are any amendments to the founding statement, these must be lodged with the registrar within 28 days and signed by each member. A closed corporation must also have its name and registration number mentioned in all notices and official documents. And then here we get to the solvency and liquidity test that I mentioned earlier, point 6, that I'd like to highlight. When certain payments are made, the Closed Corporations Act requires that members do a solvency and liquidity test both at the date of transaction as well as directly almost after that transaction or payment has been made. Now, these certain payments refers to payments mostly to members, transactions with members, but it is also an ongoing or continuous consideration, the liquidity and solvency of the business. So what does it actually entail? It entails making sure that the closed corporation's assets exceed their liabilities, both at the time of payment, so just before it, as well as after the payment is made. So the business must still be solvent. The closed corporation must be able to pay its debts as they become due in the ordinary course of business, as I mentioned previously. So it must be liquid. And that payment mustn't cause the closed corporation to become illiquid. In other words, after that payment is made, there's no more cash flow left for this closed corporation or the business to pay its debts as they become due in the ordinary course of business. So as you can see, this liquidity and solvency test needs to be done throughout the year. And if you only rely on your financial statements at the end of the year, you cannot adequately comply with this requirement. So it's a good idea to make sure that your accounting records are up to date, they're complete on a regular basis, whether it's monthly or quarterly, and the best way to do this is to use your management accounts. A closed corporation may also, not without the prior consent in writing of all the members, directly or indirectly make a loan or provide security in the following instances. To any of its members, to any closed corporation where one or more of its members together hold more than 50% interest, in other words, they control that closed corporation, or any company that is controlled by one or more members of the closed corporation. So unless you have the prior consent in writing of all the members, if you do actually make such a loan or provide security, it could be a criminal offense, and you would be personally liable as a member to indemnify the closed corporation. The members are also required to appoint an accounting officer for the closed corporation. And the accounting officer vacancy needs to be filled within 28 days. Now, very interesting, the Companies Act, the new requirements, which looks at whether you need to be audited or not, and the PI score and those requirements, it hasn't actually removed the provision for a closed corporation to have an accounting officer, which means the closed corporation must have an accounting officer, and if an audit is required, an auditor as well. And this accounting officer and auditor may be the same person if that suits your business. So you might ask, but what is the difference between an accounting officer and an auditor? The accounting officer is someone, usually an accountant, who is specifically appointed and registered with the CIPC as the accounting officer of the closed corporation. And the concept of an accounting officer is limited to the Closed Corporations Act. So it's something specific to a closed corporation. And that accounting officer has certain duties that the Act prescribes and that they actually need to fulfill and then report on as part of a report in the financial statements. The auditor is an external person or an external firm who would come in and perform specific procedures and tests on your accounting records for that financial year, and they will then form an opinion and provide reasonable assurance whether your records are materially correct and fairly represent your trading results. The accounting officer of the closed corporation, as I mentioned, must be registered with CIPC. So no accountant that is not registered as the closed corporation's accounting officer can actually perform those duties for you. You as the member are responsible to make sure that the person who will be signing off your financial statements has been registered as the accounting officer with CIPC. And importantly also, if this accounting officer position is vacant for a period of 6 months, any members who were aware of this vacancy will become jointly and severally liable for all debts incurred by the closed corporation during that vacancy. So it's very important to make sure that you have appointed an accounting officer, and if any vacancy does exist, that you fulfill it within the required time. So what does the accounting officer actually do? What is the accounting officer required to do? Well, the Closed Corporation Act provides that within 3 months after the completion of the financial statements, the accounting officer must determine whether the financials are in agreement with accounting records. So this would look at a total period of 9 months. Because with the new Companies Act requirements, your financials need to be done within 6 months after year end. And then the accounting officer has a further 3 months to do his checks and balances. And those 3 months will then add up to a total of 9 months before your financial statements can or should really be signed off by the accounting officer. The accounting officer also needs to review the appropriateness of the accounting policies. So the accounting policies, as I mentioned before, are things, for example, your depreciation method that you use on your assets, that you decide which would be best in terms of your usage of your assets. So it might not necessarily be in line with tax. Your inventory valuation method, so for example, first in, first out versus weighted average cost. Choices like that are accounting policy choices that you need to make in your accounting records, and usually your accountant will be able to guide you with regards to that. The accounting officer also then needs to prepare a report in respect of those 2 points above. And that report will then be included and signed off in your financial statements. If you are a CC or a closed corporation that requires an audit as well, you'll have 2 reports in your financials, one from the accounting officer and one from the auditor. So once again, I'd like to emphasize the importance of these reports in your financial statements. Because you can just imagine if you have a negative report from your accounting officer, in other words, he has an adverse report, he found something wrong in your records, and he's obliged to put that in his report, that could have consequences to your business. The bank could close your overdraft facility, it could prevent you from obtaining financing, you could lose potential big customers, or if large creditors request your financial statements, it could create relationship issues. So there's huge reputational risk in that. However, your accounting officer will usually discuss any matters that they do find that are adverse with you before he signs off. So there will be an opportunity for you to try and correct things before it gets signed off. The accounting officer must, by registered post, report the following things to the registrar, which is CIPC, should they become aware of that. So if the closed corporation is dormant and no longer trading, the accounting officer must report that. If there's a change to the founding statement that hasn't been registered, if the liabilities exceed assets, in other words, the closed corporation is trading while still insolvent. And if the financial statements incorrectly indicate that the asset exceeds liabilities, in other words, the financials show that the business is solvent, but the accounting officer actually finds that is not, then he or she is obliged to report that. So it's extremely important to work closely with your accounting officer to make sure that your records are up to date and that their report reflects that, and if there are any adverse points, that this can be sorted out. Moving away from the Closed Corporations Act very briefly, I'd like to touch on the Tax Administration Act, because there are various provisions in the Tax Administration Act that also affect members of closed corporations. So firstly, we're going to look at instances of criminal liability. So the Tax Administration Act says that any person, so including members of closed corporations, who willfully or without just cause fails or neglects to register with SARS, whether this is for VAT, PIYE, income tax, whichever is applicable, fails or neglects to retain records as required under the Act, fails or neglects to submit a return or document to SARS, or issues an incomplete or false document that is required under any tax act, or fails to appoint a representative taxpayer or notify SARS of any changes, or submits a false certificate or statement, or prepares, maintains, or authorizes the preparation of false books or records, or fails to comply with any directive or instruction issued by SARS, these persons could be guilty of a criminal offense. And the penalty that it carries is usually a fine or a jail sentence of 2 to 5 years. So it's potentially quite serious. This includes also not supplying records or documents to SARS as they require it, or to actually assist with an audit or inquiry of SARS. So if you obstruct the procedures of SARS. And it also comes into play fraud being a big issue. So if you try and obtain a false refund or an exemption through submitting a false statement or false documents as part of your return, that could be very serious as well as a criminal offense. The Tax Admin Act also looks at personal liability. So there are 3 instances where personal liability might arise. So if you are a member of a closed corporation and any of these 3 instances occur, you could be personally liable for the tax debts of the business, of the closed corporation itself. So if, as the representative taxpayer, you dispose of amounts in respect of which tax is chargeable while taxes are still due and they remain unpaid, or you part with funds in your possession which could have been used to pay tax, you could be liable for that tax debt. So if there's, for example, income or profits that you distribute or you pay salaries from and you haven't yet paid the tax, you could potentially be liable for that tax. Or if you use funds, cash that could have been used to pay tax for other purposes, and you then don't pay your tax, you could also be liable for that. If a person dissipates the assets of the closed corporation to obstruct the collection of tax debt due by the closed corporation, so if they use those assets, or cash probably, to prevent tax from being collected, then they could also be liable for that tax debt. And if a person who controls or is regularly involved in the management of the overall financial affairs of the closed corporation, so if you're an owner-managed business and you are the member who manages or controls the business, this would be you. If you are negligent or fraudulent in the payment of your tax debts, then you could also be held personally liable, even though the closed corporation is a separate legal entity from you. The Closed Corporations Act also provides for an association agreement that can be drawn up among the members. And what is this association agreement? It's a written document, and it regulates the internal relationship between the members and the closed corporation. Now, this is not a compulsory document, but it's highly recommended because it's very useful in regulating relationships and for setting out the responsibilities and duties of all the members. Now, the provisions in this association agreement may not be inconsistent with the Act, but it could contain additional or amended responsibilities of the members. So it's important that you understand and are aware of the certain clauses and sections in the association agreement if you do have one. These agreements must be signed by each member. And very interesting to note, if you are a new member that comes into a closed corporation after it has been formed, you will be bound by the existing association agreement as if you had signed it. So if you do come into a closed corporation almost as a new member, just be aware that if there is association agreement, you know what is in it and that you do abide by those responsibilities as well. Moving away again from the Closed Corporations Act, we've looked at the Tax Act. I'd like to make a link to the New Companies Act. Now, we've mentioned that there are a few provisions in the New Companies Act that affect closed corporations, but there is also a very specific part of the definition of directors in the New Companies Act that could affect members of closed corporations. Now, the Closed Corporations Act itself provides that every member is allowed to participate in carrying on with the business, so they are allowed to manage the business, and they have equal rights and authority to power to act on behalf of the closed corporation. So as a member, you are allowed to manage the business, and you are equally with your other members allowed to use your powers to act on behalf of that closed corporation. If this is the case, and you are an owner-managed business, you are the member and you also are in a managerial capacity in your business, then this definition of directors per the Companies Act will be applicable to you. So as part of the definition of directors, it includes an ex officio director. And what does this mean? It's a person who holds office as a director of a particular company solely as a consequence of that person holding some other office or title. So this includes people who do not bear the title of director specifically, but they are in a managerial position. And those would be members of closed corporations who bear a directorship almost in the closed corporation because you act as a director of that closed corporation. In the Closed Corporations Act, interestingly as well, there is a liability for members for negligence. So the members are still required to act with the degree of care and skill that could be expected from that person with their knowledge and experience while carrying on the business. And you'll see when we go to the next slides that this is actually quite in line with what the Companies Act is saying directors are required to do. So if you are a member of a closed corporation and you are acting in a managerial position, the definition of a director per the Companies Act will also be applicable to you, which means that the duties of a director as part of the new Companies Act will also be applicable to you. So you are not therefore only required to comply with the Closed Corporations Act duties, but the Companies Act duties of a director as well. So in the next slides, those of you who might have been following our previous webinars, you might see that these slides are quite familiar because they are coming through from our webinar where we spoke about the duties and responsibilities of directors. But I will be looking at them in detail again today because they are applicable to directors of closed corporations as well. So wherever in the slides it mentions company or the word director, or I might speak about company or director, please read it also as closed corporation and member, because in this instance it will be applicable as well. So the Companies Act requires directors, or in this case members of closed corporations who act as directors, to apply the duty of care and skill. The director is required to act with a care, skill and diligence that could be expected from someone with that director's knowledge and experience. In other words, more is expected from directors with above average skills. However, you have no excuse if you are not formally qualified or experienced, because everyone will be subject to the ultimate reasonable person average, because from a reasonable person in that director's position, they will also test whether you delivered a duty of care and skill. You cannot then therefore plead ignorance. The Companies Act also requires fiduciary duties from the directors, and this links up very nicely to the fiduciary relationship that was mentioned in the Closed Corporations Act that we looked at in a few slides previously. The director also stands in a relationship of trust to the company, so the same as a member between a closed corporation. And the Companies Act requires the directors to act in good faith, for a proper purpose, and in the best interest of the company. What does this specifically entail? A duty not to exceed his powers, a duty not to exercise his powers for an improper purpose, a duty to maintain an unfettered discretion or unbiased judgment, not to compete with the company, and to avoid conflict of interests between the director and those of the company or the closed corporation. And that includes a financial conflict of interest. So, for example, paying salaries to your members when you know you won't be able to pay SARS or your creditors. The fiduciary duties, this duty of fiduciary duty, as well as the duty of care and skill, is derived from common law, and it's specifically been put into the Companies Act to draw your attention to it and to make it statute so that the directors have to comply. You can also see the similarities between these fiduciary duties in the Companies Act and those mentioned in the Closed Corporations Act. They are very similar. The Companies Act also requires independence of action from the director. You must always act independently from any restraint or consideration, solely in the best interest of the company as a whole, in this case of the closed corporation as a whole, and also take a future view. So always look at what your actions today, what effect that might have on the closed corporation in the future. Are you still acting in the best interests of the closed corporation if this transaction plays out over time? Directors are required to vote independently, to recognize the inherent potential for conflict of interests, and to accept that the primary duty is always to act in the best interests of the company. Or, as I mentioned, please read that also as closed corporation. The duties relating to a conflict of interest stems from common law as well as the Act. So the common law fiduciary duty requires directors to avoid any conflicts of interests, whereas the Act says that if there is a conflict of interest, the directors need to disclose that at board meetings. And if it's their own financial interest, or if it's that interest of a related person, it will still be applicable. And the related person's definition in the Companies Act is really broad. It includes, for example, your spouse, companies that you might be a director or a member of as well. So those financial conflicts of interest will also come into play. The Act requires that these conflicts of interest are fully disclosed, and as a new requirement, that this member actually recuses themselves from the decision or from the meeting itself. So as an owner-managed business, if you are a one-man show, you have even more responsibility to maintain your duties and avoid conflicts of interest, because there are no other members that hold you to account or that can question your actions. You need to take account for your own actions and judgments and make sure that you are actually avoiding conflicts of interest and acting in the best interest of the closed corporation. A director or member of a closed corporation is required to avoid reckless trading. Now, what is reckless trading per the Act? It's carrying on business recklessly, with gross negligence, with the intent to defraud a person, for fraudulent purpose, or carrying on trading while the closed corporation is unable to pay its debts as they become due in the ordinary course of business. So once again, we are stressing the fact that liquidity and solvency is so important. If your accounting records of the closed corporation are not up to date and complete, this could be a sign of gross negligence, and it could mean that you are going into a situation of trading recklessly. Because if you don't have accounting records that are up to date, how would you know whether your debts are payable? How would you know that you have enough cash flow to be able to do that, or when they are actually due? So you need some sort of financial reporting to be able to make proper financial decisions, and the best form to do this is to receive regular management accounts. It also enables your accountant or whichever professional you are using to assist you to be able to give you the best advice they can, because the better your information is, the better decisions and advice you can actually get. So when we look once again at the debts that the Act talks about, it's not just your big debts like mortgage bonds and long-term loans and official debts that you've signed with the bank. It's your everyday debts. Your photocopy machine that might be on a rental, being able to pay that. You might have a stationary creditor that you need to pay. SARS, salaries, your normal creditors. It's every type of payment that you need to make, interest that you need to be servicing. As your business runs, these need to be payable. Another consequence of not meeting your requirements or possibly trading recklessly is a reportable irregularity. Now, usually a reportable irregularity used to be the auditor's duty to report. If they find anything that is a reportable irregularity, they would put it in their report and they need to report it. But it's no longer the case. All professional accountants now have the duty to report on whatever is a reportable irregularity if they do find this. So what is a reportable irregularity? It's any act or omission committed by any person responsible for the management of company, so the management of a closed corporation, which unlawfully has caused or is likely to cause material financial loss to the company or any member, shareholder, creditor, or investor of the company. So not just, in our case, the closed corporation or its members, but any outside stakeholder as well, creditors, possibly the bank, anything like that. Or it is fraudulent or amounts to theft, or causes or has caused the company to trade under insolvent circumstances. Once again, the emphasis on insolvency. So when we look at material financial loss to the company, this materiality is usually a rand value above which any losses or errors would have an effect or an impact on the decisions of users, or will have an actual impact on the company itself. But it could also be qualitative. So it's not just a rand value. It could be something like fraud or theft as well, which makes it material. Once again, insolvency, if your assets are exceeded by liabilities and you cannot pay your debts when they become due, this is something that is subject to being a reportable irregularity. So as an accounting officer, being professional accountant, he or she might have to report on a reportable irregularity if that comes up in your closed corporation. And once again, if a reportable irregularity comes into your report in your financial statements, or it is reported on, it could be potentially quite serious. Because if you have a qualified report in your financials, it could have consequences, as we mentioned before. It could prevent you from obtaining financing. It could affect your liquidity and solvency and your customers. It could have a large reputational risk. The members are therefore required to prevent a reportable irregularity. And some examples of these are, for example, trading recklessly, the existence of fraud, trading under insolvent conditions or not meeting the solvency and liquidity test. As we mentioned before, making sure that your assets exceed liabilities and that you are able to pay your normal debts as they become due during the course of your business. If it's theft, contravention of any legislation, in other words, non-compliance with laws or regulations, or any illegal acts. So the members of the CC could therefore be personally liable for contravention of these duties per the Companies Act and not only just the Closed Corporations Act. Now, in this webinar that we've done today, as well as some of our previous ones that you might have followed, you would have noticed that I've stressed the importance of management accounts and having up-to-date financial accounting records and being able to make your decisions based on these. And for those of you who are not sure what management accounts are, or for those of you who have management accounts, you do receive management accounts, but you'd like to find out how you can use them more effectively and how they can actually be used optimally in your business for financial decision making, I invite you to join us at our next webinar, which specifically looks at management accounts. What are they, why you need them, and how they can help you. It is on the 24th of August at our same time slot, 9 to 10, and we would love for you to join us. Thank you very much for joining us in today's webinar. If there are any questions, please feel free to send them through. Thank you, Shane.